This video is going to discuss the narrow range breakouts. The goal is to buy a breakout of these low volatility patterns if it goes up, and sell a breakdown of this low volatility pattern if the price breaks down. What is an NR narrow range pattern? An NR pattern is just a period of low volatility. Low volatility periods often precede high volatility periods, which most people call trends. There's three different types: NR4, NR7, and NR7 inside bar. The NR4, the bar is smaller, the high minus low, than the previous four bars, and price is inside the previous bar's range, which means the high is equal to or less than the previous bar's high, and the low is equal to or greater than the previous bar's low. In other words, if you looked at the previous bar, this last bar is inside of it. It didn't break out whatsoever. NR7 is a bar that is smaller than the previous 7 bars. It tends to find more explosive trends than the NR4 bar. Then there's an NR7 inside bar, which is similar to the NR7, but price is inside the previous bar's range. Rules. Preferably trade these in the direction of the hourly moving average. If price is above the hourly, look for buys, and below the hourly, look for sells. Preferably trade these in the direction of the weekly trend. If weekly trend is opposite of the hourly, then prefer the hourly. In other words, if the weekly trend is down, but price is above the hourly, and the price breaks out of the narrow range volatility pattern, then you want to buy. Preferably trade these in the direction of the monthly trend. This is the least important of these rules. And if a currency is up 3+ days, prefer selling, and if down 3+ days, prefer buying, because trends don't go one way forever, and after a big multi-day move, a low volatility pattern often precedes a trend reversal. Markets frequently go from periods of high volatility to low volatility to high volatility and low volatility. If you know where a low volatility period is, when the market breaks out of that area, it frequently turns into a high volatility area, which most people would call a trend. Let's look at this dollar Swiss right here. On our charts, we have yellow ones that show the previous 4-hour bars if they're a narrow range pattern, or white when there's a narrow range pattern over the previous hour. NR4 means this bars, hours, bars, high minus low was less than the previous 4 hours, which you can clearly see here, here. To use these in trading, basically when you see one of these patterns show up, you want to buy the breakout here. Now obviously a breakout, if the weekly and monthly trend is up, in this case the weekly trend slightly up, the monthly trend's pretty weak, and so therefore you would have bought that breakout right here. We have some counter trend signals showing up. The upper containment band is a likely place to stall. This one didn't generate too big of a move. Here the market broke out. If you bought here, your stop is a few pips underneath the previous 4-hour bar's high, and the market went up to the previous day's high, which is a resistance area. The market has some selling at resistance area, and then it came back down and stopped you out. You want to look for these into the future too. If the market has a narrow range pattern and it breaks out, you get into the trade. Sometimes you have a small win, sometimes you have a small loss. But later on, if the market's not making a lower low and it's spending its time above the hourly moving average, and preferably the daily, weekly, and monthly trend is up, when the market finally later breaks out of that range, you want to be aware of that in the past, because it's more likely to trend. And you can see later in the day around 8, you would have got into that trade, and many of our traders would have got in right at the hourly moving average, the previous month's low right here, when the market came down without much weakness. The previous thrust move up before was a lot stronger than the weakness moves. They might have got in when the IntelliTrend shifted green right here. Notice the IntelliTrend, with the exception of this one bar, stayed green all the way up to the high. But if you bought the breakout of the previous day's high, knowing that there were narrow range patterns before, breakouts therefore are more likely to work. You got in, maybe you got out of half your trade, you drew your fib from this first wave up, and look to exit at the first or second fib target up here. Let's look at some other examples. Okay, here we have the Australian dollar. Now the daily, weekly, and monthly trend is up, but the price is underneath the hourly. Underneath the hourly, you want to focus more on sells. Above the hourly, you want to focus more on buys. Now, if the weekly and monthly trend is up, as in this case, and the market does break down, you're less likely to have a really huge move. Most huge moves outside of narrow range breakouts happen when all time frames are all in alignment. So here, if you were shorting, you'd be going against a longer term trend, and therefore, common sense dictates you're going to make less money if the trade works. So when the market broke out right here, came down to the previous day's low, we have a counter trend buy signal. The market is extremely weak, and you might have got stopped out of this with a small loss because the market did reverse immediately back up. Not surprisingly, because the weekly and monthly trend is up. But when it came back up and you got another counter trend sell signal here, because of the magnitude of that down move, smart traders might have gone short here, and when it double bottomed right here with less weakness, got out with a small profit. When the market wasn't able to get a bounce off the previous day's low, using support resistance, the first and second time support or resistance area gets hit, you're oftentimes going to get a reversal. The third time, there's rarely any more buying right here. So because it had a narrow range pattern right here and it broke down underneath a double bottom, it's a great place to go short. And you draw your fibs off this previous swing move. And because the longer term trend is up, you might have got out right here when it hit the 1.618 fib target at 41. But you were short around 81, you made 40 pips on that trade. I'm just discussing all the different ways these narrow range patterns can be used. Also, you notice here an hourly narrow range 7. That means that previous hour had lower volatility than the previous 7 hours. Those also are very useful, especially when you have a longer term 4-hour narrow range pattern before, and the market's underneath the hourly, and that's another signal. The tighter that is, the better. You can see right here that generated a small move. This breakout right here generated a small move, and so forth. It hit our lower trading zones, and you can see the counter trend buy signal right here. Because the longer term trend is up, that was the end of the move. Let's look at another example. Here's the pound yen. Now in this case, the weekly and monthly trend is down. However, the price broke out from underneath to above the hourly moving average the previous night and spent 4 hours with very low volatility. That's why the beginning of the next 4-hour period right here, you see the narrow range pattern show up. In this case, you also had a narrow range hour bar show up as well. And when the market during the next hour broke out, it absolutely took off. Now, normally when the weekly monthly trend is down, you're not going to make that much buying a breakout. So you might have decided to get out at the monthly S1 or the previous month's low right here, and then on the second half of your position put your stop underneath here, and the market just took off. Here was the first high of that move up. You draw your fibs on there, and you might look to get out of your second half of your position somewhere between the 1.382 and 1.618 Fibonacci profit target. This is absolutely a huge move. The breakout worked, and it just took off and went up 175 pips. You also see that this breakout had extreme strength. It was one of the strongest trends of the day, and our real-time statistical trend tool showed you that, which gives a higher odds of the trend continuing. All the low volatility period shows you is that when you see a low volatility period and the market breaks out, when you want to get on, and some of the trades work, some of them don't work. Later in the day, for the ones that don't work, if the market takes off again later, you want to take those trades because there was a low volatility period in the previously, and that means there's more likely to be a bigger trend move later. Sometimes there is, sometimes there isn't, but when you catch one of these, it really can make your week. Here's some more examples of this on the next trading day. We have an hourly narrow range pattern here, which you can clearly see, very narrow, very low volatility, followed by a 4-hour one. We're underneath the hourly moving average, and on top of that the weekly trend is down, so this is more likely to break out to the downside. You might have got short right here when it first broke down here. You lost 10 pips. You got short here again, and the market fell from 40 all the way down to 13, so it almost moved about 30 pips. You have counter trend trading systems. It's near a lower containment band where it frequently reverses. You can see when it hits a lower containment band, frequently price hits it and reverses. As you can see, happened all day today and most days. So you got out of this trade with 20 or 30 pips. You lost maybe 10 on the first one. The market had pretty severe weakness on the way down, so when it came back up and wasn't able to get inside that narrow range again with very little strength in comparison to the weakness, you might have gone short here and made another 20 pips. Here's another example today, the Australian yen. We had two narrow range 4-hour periods in a row. You can see during the previous 8 hours, very, very dead. And this one also was up 3 days in a row. Our FX total view shows you that. Remember, that's one of our rules. So anytime a currency's up 3 days or more in a row, it tends to be more apt to reverse down. So the price was above the hourly, and if it broke out above the hourly, you might have given it a shot by buying it, but you would have expected a small move because it was already up 3 days in a row. And just like I said, after a currency is up 3 days in a row, low volatility periods oftentimes precede trend reversals. And boy, did this reverse trend. It broke down underneath the hourly right here. You're short right around 80.10 maybe. And when it hits the lower containment band, it's a great place to get out. But it went about 60 pips. And we have off the charts weakness, so you might have decided to give it one more shot selling it right here on the pullback. Counter trend sell signal. Anytime you see a sell signal in the direction of the longer term trend, again here, those also separate system, but I want to point that out. Good trades. It adds to the probability of that trade working. So that's maybe 15-20 pips, and you made 50 or 60 on the first one. Again, because this one was up 3 days in a row, it was more likely to reverse down today. There's only one currency that had 3 consecutive days movement in any given direction. Here's the Australian dollar, also underneath the hourly, and so the odds are the price is more likely to go down. And you had an hourly narrow range pattern followed by a 4-hour one, and it broke down right here around 41, and you look to maybe get out here around 83. So that's about a 60 pip move. Again, off the charts weakness. You might have decided to sell this next counter trend move, and anytime it's underneath the lower containment band, be very cautious. Draw your fibs on the last little tiniest swing, and when it hits the fib target, especially with a counter trend buy signal with less weakness than it had before, get out. But that second trade in around, say, 70 and out at 20, so that's another 50 pip move. Very, very good high probability trades based on the beginning of a low volatility period. Here's some trades that didn't work. You have a loss, and then you have a trade that works later on. So 1 out of 3 of those trades worked, but the one that worked gave, it moved more pips than the ones that didn't work. All right, we're above the hourly moving average. The daily, weekly, monthly trend are all slightly up. And so when the price broke out right here, you go long around 50, 53. The market went up about 10 pips. You had a counter trend sell signal right here, and there was virtually no strength whatsoever. All signs that the trade's not likely to work. So you might have exited this with a few pip profit, or moved your stop to break even. You would have got stopped out with break even. And then the price broke down underneath the hourly and underneath here. Again, if you flipped and went short right here, it fell from 32 all the way down to 12. Counter trend buy signal right near 2 major support areas. And you have 2 counter trend buy signals right here. And again, not much weakness. Anything less than our dotted 20 extreme level is not that much. So you could have exited this with 10, 15, maybe as high as 20 pips profit, or at the very least you moved your stop to break even. You wouldn't have lost on that one. So you probably maybe lost 5 or 6 pips on the first one, made 10 or 15 on the second. And if you bought this breakout right here, unfortunately a few bars later, we have sell signals. So every once in a while, this is what happens after a narrow range pattern. But watch what happens in the future. Price, wasn't able to make a higher high here, which is a sign of lack of strength. And the price broke underneath the hourly here and went sideways. It wasn't as narrow as this period right here, or else it would have shown that. And when the price broke through the 10-day moving average and monthly pivot, previous day's low, very key support and buying areas, that's a great place to go short. And you always want to draw your fibs on the last move down. The bigger the move, the more likely the fib targets are going to be the low. And this just exploded down. If it would have stalled here, you would have exited half and usually get out of the second fib target with the second half. But this fell like a rock right through there. Our trend reversal triangle usually signifies the end of the down move, so you really want to exit half whenever you see those, and when it went sideways here, get out of the second half. But that was the fell from around 14 all the way down here to around 70, so it's about a 40 pip move. Here's another example that didn't really take off right away. Price is above the hourly, so we don't want to look for sells, so we would have ignored that sell right here, which obviously didn't work. That's one of the reasons why we have rules to eliminate the number of times the system doesn't work. In other words, it reduces the number of failures. So the price broke out above here, and again, our counter trend sell signal right on the bar that broke out.